When you were giving the numbers of stocks that you own, uh, those were some pretty small numbers compared to a lot of your peers. Why are you kind of okay with that more concentrated position, and why do you shy away from the hundreds of stocks that many mutual funds go for?
Well, Justin, we've always considered ourselves to be active managers,
Mhm.
and if we have a good idea, we want to have more exposure to make more from it.
Yeah.
And if we're wrong, we can always sell and cut
Right.
losses. I
Right.
think I think that someone once said to me, ego and emotion are the assassins in this business.
Hmm.
And one of the most important things is to be able to take a loss.
Yes.
And that's all about humility. We're kind of trained to think it's about being right. We listen to the news every day, and we hear all these smart people, and they always sound like they're so smart and we're so stupid, especially people like me who are inclined to be bullish. The
Uh,
bearish people always sound so much smarter than I do, and feel like they're telling me tapping me on the shoulder, telling me how dumb I am. But
or
no, I'm an optimist. I'm an optimist. We're a product of our experience, and I was lucky enough after I left law to start out in investing in venture capital.
Mm,
And I basically said, why is everybody so afraid of taking risk when there is this much upside in equities? And over the course of the past, since then, 30 years or so, the technology revolution has grown more powerful with each passing year. The technology revolution being measured by the exponential gains in processing power each year that have occurred. So that I look back and when I started at Lord Abbett in 2001, and I consider today, and today, $1,000 of computing power buys you a hundred billion times what it bought you in 2001. A
yeah.
human brain versus an insect brain. So I believe that the tech revolution continues to be very powerful and is enabling incredible innovation in the economy. It starts with the semiconductors and the software, which is generating the power. It makes its way to the consumer, where 2/3 of spending is, and it has the capitalist system, the free market capitalist system, has an amazing ability to create solutions that meet our needs at the various hierarchy levels of our existence: the physiological, the safety, the belonging, the self esteem, the self actualization.
Hmm.
It's ushered in things like e commerce and social networking, which make consuming much better. And we've had huge advances in medicine with biotech and devices and diagnostics. And we have brand new markets opening up, the electrification of everything, digital money. So I'm very, very bullish, looking forward over this decade and next decade, that equities are going to go a good deal higher. But our process, which uses technical analysis, recognizes that stocks have big cycles. Stocks go into bull markets. They last, for the big winners. Sometimes they last 18 months.
Hmm.
Sometimes they last as long as 4 years. And then there is a big bear market. And when that happens, we like to step aside. Amazon fell 95% in 2000 to 2002. Names like Green Mountain Coffee Roasters, which got taken out, that was a big stock that we owned,
Hmm.
went down 80%. I think it was in 2012. Netflix went down 80% in 2012. So these stocks, even if they keep going up year after, over decades, they have these big corrections. And when that happens, we like to bring them down. But if you're gonna be successful as an active manager, you have to take risk, and you got to be able to withdraw risk. And so one of the ways you do that is through some greater concentration than being diversified, as Peter Lynch used to say in his book One Up on Wall Street.
Hmm.
So when a position goes against you, and when you're hitting your stop losses, there have been times where you don't hesitate, right? You would think like, A mutual fund would, oh, let's just slowly, gradually move out of the position. I was pretty impressed after hearing that there are some times where the numbers are really bad after an earnings report, and you're like, let's just get out of it.
Yes, yeah, we're very decisive. I'll give you an example of Zoom. So the pandemic breaks out. I have a friend in the business who's a technician who calls me and tells me that he knows somebody who used to work at CDC, who tells him this is a really bad situation. So we immediately buy Zoom, and it zoomed. And to fund that purchase, we sold Live Nation, which we figured
Yep.
was not going to do very well if concerts got shut down. That
Makes sense.
plunged 60%. But then on vaccine day, Zoom fell from 520 to 420, and we were out 100%, because we said all of the upside that people were dreaming of is gone.
Yeah.
And
you were seeing it on the chart too, right? So
the market often taps you on the shoulder and says it's time to get out. And so yeah, we are very decisive.
That might not have been a tap, more of a slap.
That was a punch. That was a punch in the nose. Yeah,
Yeah, exactly.
exactly.
But to your point, you were decisive. You didn't kind of get a deer in the headlights like, oh, now we do. You just made the decision. Hey,
That's why
it's time to move on.
you gotta take the ego out of the equation. Okay, this is not about Tom. This is about the team of people that Tom works with. This is about following an investment process and trying to make good decisions. There's just important decisions to be made all the time, and you just want to try to make good decisions. And one of the things that's important is to get a good night's sleep and make sure your mind is rested. I mean, I could spend all day reading about my companies all night, and but then I'd be making bad decisions about the stocks because I'd be cranky the next day. So it's I love what I do. Every day I come in is like playing for the Stanley Cup. I played ice hockey in high school and college, and this is so exciting. Every day there's some drama, something to do, something to talk about, and but we're very active managers. But when we see things like the vaccine from Pfizer, and then what followed after that is the Democrats took the Senate, so you lost divided government, and that created more fiscal stimulus, and that aggravated the inflation problem. Then you had the war in Ukraine breakout. That was unexpected. That aggravated, and so you never know what the market's going to throw at you.
Yeah.
But when it does, you need to think about the implications and then take action. We don't want to be, I don't want to be, our turnover in all these funds runs around 90 to 140% a year. I'd say a central tendency of about 125. The tax situation associated with that is better than would appear because we're more inclined to let the winners keep running as long as they're running and taking losses sooner.
Yeah. Well, so now to that end, you kind of had your Zoom example, which I think is, pretty extreme. Just like, that amount of a drop, and you're just like, no, I'm not going to be any part of this. I'm not going to wait for it to return. Now, what about stocks where the move is a little bit more gradual? You were talking about some of these stocks that did come back, like Netflix and Amazon. Do you get out of them while they're going through that major corrective phase? We're talking about the 80% drops.
Oh yeah,
and then you just get back into them.
Yeah, you just get we try to get out of them when they're going through that type of phase, and then and what we'll see is we look at stocks in 4 categories, and one of the interesting things about our team is we have a full-time technician, Vernon Bice. So Vern's spending 100% of his time on the charts. And so we look at the world in terms of 4 frames. Number 1 frame is an uptrend. The 150-day moving average is moving up. The stock price is above that. That's something we're inclined to hold. If we don't own it and we have a good reason to buy it, we're inclined to buy it. And then there's a downtrend where the 150 is going down, the stock is below that. We're generally inclined to stay away from that.
Mm-hmm.
And you do have issues like you do have like the Googles and the Amazons and the Microsoft, which are so big in the benchmark
Right.
that, like Apple, for example, is 14%. So to be zero in Apple is taking that's a big risk. So we don't do that. So, but when this and then the interim steps are an uptrend first becomes a pullback, where the stock price goes through the 150, and that puts the risk antennas up. That's basically, could this uptrend be coming to an end? And often it's not. And so we just say, let's just chill, and the fundamentals still look good. We think this will resume. But let's, if we think there's something wrong, maybe it's appropriate to cut it. And if it keeps going down, then and the 150 starts to curl down, we're on the verge of a downtrend. So that might be what tips us out of a name. And on the other side, a name that's been in a downtrend, when its stock price goes up through the 150, that could mean the beginning of a new bull market. So that puts up the opportunity antenna above our ears, and might be reason for us to buy it. Now, as I said, we're seeing a lot of snapbacks right now. It's better. And I said we use the 150. You could use the 200. We just find the 150 is a little bit better for us.
Mm-hmm.
But if you have a snapback, it would be better if that 150 has come down long enough and is flattening out, and the stock price is lifting up through it, than if it's just gone straight down and the stock price is lifting up through it. So, we use the technicals as an integral part of our process. It's anytime anyone asks me about a stock that I don't know of or I haven't looked at lately, the very first thing I do is let me see what the chart looks like, as a starting point to begin thinking about what to do with it.
And so how do you, you have a team, you have Vern managing the technicals, you have others managing the fundamentals. How do you balance that out? Is it, in the end, is it the chart that, well, what if it's kind of like in the neutral kind of place? Is there like kind of a debate there that
a tiebreaker?
Yeah.
Well, we have the three circles as our process, and it's very hard to get somebody who has never learned technicals to stitch that onto their DNA.
Right.
It takes a lot of time, and we're very patient about it. I have the final say. I'm the lead portfolio manager. I know that I myself, if I'm really good, will be right 60% of the time. So I hope the 40% I'm not, the people in the room will tell me I'm wrong. But Matt DeSico has been a portfolio manager, has been with us since 2002. Okay. And he's been he and Vern and I have, have been the three amigos for a long time. And
that's awesome.
We can finish each other's sentences. So I would say that, we give rope sometimes if someone likes a name and it's just begun a snapback. We'd like to see a better technical profile. Maybe we might start with 50 basis points instead of 100. That type of thing. So
that makes sense.
So again, it's a team, it's a process, and with mutual respect and an understanding that that's what it's all about. Everybody is gets along well, and we try to make the best decisions we can as a team. And nothing more fun than winning as a team and putting up good numbers.
And I just wanted to kind of circle back a little bit, because we had talked about how, again, you're focused on growth, and I think that's where Arusha and I fall to. And again, this market has been very commodity related. You mentioned how a lot of the lists that you were looking at had a lot of energy, splattered all over it. I mean, for a while there, you had the tankers and steel stocks and all of this. So, remind me again, what is it that you do in this environment? And again, we're not quite sure. I feel like the sector rotation has kind of been a little bit tricky to handle lately, because even the ones that were working kind of seem to not be
Mhm.
working, or it's shifting very quickly. So where are you putting your money in that regard? Do you just stick with growth that's maybe a little less volatile, or do you do some of that switching?
We definitely don't stand still, and
Mhm.
our investment process has led us really since the day of the Pfizer vaccine to move toward a more defensive posture. And by that I mean the search for operating momentum and technical momentum. And don't you know when we're looking at technical momentum, it's not only absolute price momentum, it's also relative price momentum.
Yeah.
When you're in a bull market, both are always important. But so I would say what happened was, as 2021 unfolded, that process led us to own much bigger positions in Microsoft, Google, and Apple in aggregate than we had had in 2020.
Mhm.
As time went along further, it led us to move into, big healthcare services names and big pharmaceutical names. And we were probably too late to get into energy, but we got into energy with some pretty good size holdings at in the first quarter of 2022, I believe it was.
Hmm.
So what happens is the investment process leads us to relatively better operating and technical momentum stocks as a way to try to beat the market and the peers that we're up against, or if that's not possible, to lose less to the
Yeah.
market than. We're offensive investors, so I've never seen a bull market that I didn't love to do a cannonball into. We haven't had that in a long time, but or any given stock. If there's a stock that's beginning a bull market, I'm naturally and we're naturally inclined to move into that stock. So our investment process leads us to better operating and technical momentum, no matter what the environment.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.